it's been a massive week for the company, and we're sort of starting to join a few of these massive weeks together, but essentially announcing this sort of innovative funding package, again with thanks to the CPS Capital team, to be able to essentially accelerate and bring forward our development plan. So absolutely delighted to have that information out into the market and to be progressing that. Also, don't want people to lose sight of what's going on, on the ground in Oklahoma. This is the beginning of our busiest period since we started the business, back in 2015. And if you think about that, for a relatively small team to have a well about to spud, rig moving in, and a well about to spud, and simultaneously we have a completion about to start on our range as well. And if you look at the photo on this first slide here, you can see the amount of equipment that came in for the completion of the Jewell Well. So you can imagine that's what's going on the ranges DSU at the moment. So unprecedented period of activity for us, and we're absolutely excited and looking forward to the outcome from both these two wells. I guess in terms of the macro picture, we've got oil at 10-year highs. We have, as I said in the intro, we have accelerated our development program. We're now fully funded to complete our HBP program. And really, most importantly, we're now, staring, at the opportunity for very strong cash flows to come from the success of our first 3 wells that will set us up to unlock the value in our proved undeveloped reserves that are sitting within those drilling spacing units. So, just a fantastic time for the business in terms of being able to be drilling, completing, producing at a time when the oil price is at decade highs. So with that, I'll start to flick through the rest of the presentation. Obviously, the important notice and disclaimers, take your opportunity to read that. If you're a speed reader, you can do it now. If you're not, come back to it later. So on the macro picture, as I said, we're sort of almost having to update this slide on an hourly basis at the moment. I think the WTI's even moved higher than that little grab that I picked up last night. I think we're sort of around 123, 124 now. So at decade highs, and driven mostly by fundamentals, I think. I mean, certainly there is going to be some premium in there for geopolitical activity that's going on at the moment, but certainly we think that it's fundamentally being driven by supply and demand issues. We've had years of underinvestment in the sector, and and as the world starts to emerge out of COVID, we're seeing demand starting to roar back. And unfortunately, like all commodities, it's very, very difficult for supply to be able to respond quick enough for that increase in demand. And so you see the price action that you're seeing now. So absolutely perfect timing for us to be ramping up our production. If I look back to the period in 2020 when oil prices were on their lows and we were cutting our cloth to suit at that time, to fast forward to today with 3 wells about to come into production, and 1 in production and 2 more about to come into production, and delivering all of that production into oil prices above $100 is just a dream come true for us, and I think for shareholders. So just touching on this week's announcement, what does it all mean? So it's fundamentally all about accelerating the development. So we're really bringing forward the last of our HBP, the last well in our HBP program, by about 6 months in terms of the actual operating program. So what that means is that we'll have 3 big wells on production by the middle of this year, and as I said, producing into the highest oil prices in more than a decade. All 3 of those drilling spacing units, so the Jewell, the Ranges and the Flames, held by production before the end of the first half of this year. And that is key to this acreage revaluation process that we talk about, where taking it from being leasehold to being held by production is the last piece in the jigsaw puzzle to being able to book proved reserves for that acreage. And it's all of those infill, low risk, high impact infill wells that creates the value in the acreage. So, you know, this last step, or the last few months of the first half of this year, is where we prove up that inventory of extremely high quality, high impact, very, very low risk development wells. And this is something that we've been working on for years, and you know, this is I guess the fruit of all of that labour. The free cash flow that comes from that HBP program is what we're going to be able to use to then accelerate the development of those additional wells into the second half of 2022. So busy now and getting busier as the year unfolds. Just a few words on, I guess, you know, how we go about conducting ourselves in Oklahoma, and generally speaking, recognising sort of, I guess, the importance of ESG in terms of the investing climate at the moment. Our social license to operate in Oklahoma is actually baked into the way we operate and the way we conduct ourselves, and it's sort of somewhat unique, almost unique to Oklahoma, given the land and leasing situation in Oklahoma, where predominantly we are dealing directly with the farmers and the owners of the land that we operate on. So it's in our interest to work closely with them to make sure that they're happy with the development, and they are the direct beneficiaries of the work that we do. So that both in terms of royalties and in terms of, you know, jobs, high-paying jobs that they or their family members might get out of our activity. So I guess, you know, the environmental side, the social side, and the governance side is sort of baked into the way we do things. And you can look around the diagram there and sort of start to look at some of the unique things that we think, being a boutique energy company. So, you know, relatively small standalone developments, and again, I say, you know, working in very, very close cooperation with our surface owners or the farmers in the area. You know, quick return on capital. So, you know, access to pipelines and infrastructure, so we can turn our wells to production as soon as we bring them on. You know, working with service providers that make sure that they're tuned into ESG, you know, policies, I guess. So low emissions. You know, having a small environmental footprint. And just generally speaking, operating in a way that sort of tries to minimise the impact on the land and the community.
And if I could add to that, we do work with the local towns in the area, like Tatum's, for example, where the Jewell DSU is located. We have helped with some sort of town projects, made some donations to the local community to help them with certain infrastructure issues they were having in regards to sewerage and pumping and so forth. So it's not even about just giving back in terms of employment and, let's say, royalties to landowners and townships, but also actually putting money into these local communities to improve, I'd say, their way of life, improve their community environment in general.
Yeah. And look, this is not something that's unique to Brookside. This is something that good quality, privately owned, very successful, you know, private E&P companies have been doing for decades. If you're a good corporate citizen, you get a reputation in the field for doing the right thing. You're looking after the local communities and looking after the landowners. Then you get to come back and expand your acreage and drill more, and it's a win-win for everybody. So it just makes good commercial sense to do these things. So in terms of our Brookside's three pillars, I guess this is how we operate and how we create value for shareholders in all parts of the cycle. So, you know, today we're sitting here with oil above $100 and everybody's excited. But if people who've been shareholders of Brookside for a long time know that we were able to generate outstanding returns in terms of profits and growth, even when the oil price was on its lows. And this was because the other two pillars of our business, our land and leasing and our PDP acquisitions part of the business, came into their own during that low point in the cycle. So high prices today means that we're focused on drilling and completing and producing. That's what we should be doing. That's what all of our peers are doing. And that's effectively the harvesting part of the cycle. So we're very much focused on that at the moment, but we will never lose sight of those other two pillars, because they're always there, and have the opportunity, that they have the potential to deliver up, outstanding results for us at any time.
And that, you can't underpin that point, is anyone can make money in the oil and gas game when oil's at $125 a barrel. And little companies have projects that have been underwater for years, and suddenly they're making money, and it all looks good. Brookside's a company that made money regardless of where the oil price was. The oil price was down and depressed, and Brookside still has pillars to capitalize on, still make money and return for investors. And that's what differentiates us. If we're making money at $40, $50, 60, then it just goes up, linearly, almost exponentially at 120. We make money at low and high.
Absolutely. So this slide really is what it's all about for us. We've been banging on about premium well economics since we took our first acres in the SWISH area. This underpins everything, right? If we make sure that we let the engineers and the geologists identify the formations that are going to return premium results when the oil price is low, then we get super premium when the oil price is high. And we look here at the high rates of return and giving us higher profits. And what we've done here is just to set out for you, I guess, the two productive formations. And I'd sort of try to ask people to spend a couple of seconds here to try and absorb what we're talking about here. So the Sycamore Formation, if you think about it in terms of layers of a cake, the Sycamore Formation sits on top of the Woodford Formation. They're both productive. They're both about 300 or 400 feet thick. And so when we talk about these low risk infill development wells, or these proved undeveloped locations that sit within our acreage position, one sits underneath the other. So there's no additional infrastructure required. There's no, and once we prove up one in the area, then we unlock the value in the entire, both layers of the cake. And looking at those numbers on the table on the left hand side, I mean, these are stunning numbers. They will compete, compete easily with all of the best basins in the US. And for us, things like time to pay out, so sort of 6 months in terms of the Sycamore Formation, and less than a year in terms of the Woodford Formation, the break evens at less than $30 a barrel. This is where the value gets created in our proved undeveloped reserves. And then on the right-hand side there, we talk about the benefits of these big premium wells. So when we talk about big wells, we're talking about big in terms of initial production rates and big in terms of estimated recoveries. But what does that all mean in terms of dollars and cents? Well, it's fast payback time. So we talk about there the 6 months and less than a year on the Woodford. That's crucial because it enables us to recover capital from the well bore that we've put into the well quickly and recycle that into the next bunch of wells. So that's crucial for the success of the business. The other point to make here is big wells means that we grow production quickly with a relatively small number of wells. They're high impact. We bring one well on, it comes on at 1,500 BOE a day. That's material for our business. We bring another one that comes on at 2,000 barrels a day. All of a sudden, we're starting to add material amounts of production with only adding a few well bores, and that translates into low operating expenses. And obviously the holy grail for in the oil and gas business is to be producing at this time in the cycle, but with having the lowest possible operating expenses. And you can do that by having high impact wells, so a fewer number of wells delivering a larger production outcome. That translates into higher profits. So that's really the punchline from this slide. Really quickly on the corporate overview. Looking at the capital structure, market cap of about 78 million. We 3.5 billion fully paid ordinary shares, 1.5 billion of the BRKOBs. You will have seen in the announcement there that we've reached an agreement with CPS to partially underwrite the exercise of those options. Cash at the end of December about 12.7. 3,500 acres in the Anadarko Basin and prospective resource of 11.6 million BOE. I should make the point that 11.6 million, I know there'll be questions from some of our very long-term supporters about that. That prospective resource is net to Brookside, so it's ex royalties and net of our operating subsidiaries back in. So that is the absolute net. That's not a wellhead number. That is an absolute net to Brookside number. And the only reason it's currently classified as a prospective resource is because we haven't finished the HBP program. Once we finish the HBP program, that 11.6 million barrels of oil equivalent turns into a proved reserves, or there'll be PDP and proved undeveloped reserves, and it will likely get bigger. We've seen better well outcomes from the wells we've drilled so far, and we've obviously seen prices move higher. So that's a very conservative number, and I hope that explanation helps some of our shareholders to understand what's the significance of that number. We have a growing production base. We talked about the 1 well in production, 2 wells about to come onto production, and we're unhedged, delivering that production into these decade high prices. Another quick mention for CPS. I just can't understate the importance of the capital that they've raised for us since over the last sort of 18 months or so, has been instrumental in getting the Jewell Well drilled and completed and into production, and it's enabled us to ramp up our activity to be in a position to say that we're now going to have that HBP program finished by the first half of this year. So without that capital, we wouldn't be in the position that we're in today, and I want to thank those guys for their support.
And could I just reiterate the fact that we are unhedged, and something that the market doesn't always understand is a lot of companies will hedge the oil price, especially when it's lower, and people have locked in 60, 70, maybe $80 per barrel. When it goes above 80, they don't get near that. It goes to the people that are hedging. When it goes to 125 for us, we get all of that. We are unhedged. Any upside, everything goes to us. So that's really fundamental, because what you're seeing on the screen when you look at oil price, that's what we get paid for our oil and gas.
Yeah, good point. Okay, in terms of the corporate structure and the teams, real quick, most of you are familiar with the corporate structure here in Australia. So really the focus there is, corporate commercial experience. Gracjan's got obviously some operational experience as well as his, M&A or A&D experience, with Exxon. But most importantly, for most of our shareholders, it's the Black Mesa Energy team, which is really been able to help us steer a pathway through some pretty choppy waters over the last few years, create value for shareholders, and then now we're in a position where their operational capabilities are really coming to the fore. And I really want to make the point that operational excellence in terms of delivering up these very, very large wells. These are large, construction projects. We're moving in a lot of equipment. We're drilling big wells. There's $10 million of capex goes into an individual well, and to be able to deliver these things up on budget, on time, safely, and then get a fantastic production outcome is a credit to those guys, and we're absolutely thrilled with their performance and their capabilities. We also should make the point that the ownership structure. So Black Mesa is a controlled subsidiary of Brookside. But the ownership structure provides those guys with a back in at the asset level, and that provides the alignment that everybody's looking for, so that cost control, execution in the field, picking the right locations, and then bringing these wells in on time and on budget is crucial to their success. And it's crucial to our shareholders' success. So we have perfect alignment between the operating team and the corporate entity as well as shareholders. So that's an important point to make, and something that's unique to Brookside. I won't dwell too much on this next slide. It's a little bit of history, really. Location is crucial in all of this. you know, back in 2015, 2016, we started out here in this area in the stack play. We were essentially picking up acreage as a non-operated participant in wells that were being drilled by many of the large E&P companies active in the Anadarko Basin, and we were really learning our craft, picking up pieces of information about what geology and reservoir characteristics to look for, and how to go about drilling and completing these wells. You fast forward to today, and we've got this acreage position down here in the core of the Scoop play, and what we're calling our SWISH AOI, and we've identified, and you know, I need to make the point that this was our discovery. We identified this area. It was not known amongst the majors at the time. It had been overlooked. We started leasing in the area, and now, you know, this highly sought after Sycamore-Woodford trend is literally the talk of the town. Everybody wants to be in this sort of, you know, 200 square mile area that's become so popular. And we're now completely surrounded by the well-funded tier one operators in the area who are active both in terms of drilling and in terms of M&A. So, you know, we've absolutely nailed it in terms of location, and that's been demonstrated in the results that you'll see on the next slide.
And you know, we did it once, and we can definitely do it again. That's the other takeaway here. We identified, the big guys followed us. We have the same people, same recipe in place. So, you know, correct, we can do this again.
Yeah. So as I said, this was our concept, our discovery, 200 square miles or 130,000 acres within this area. And it's hard to imagine, but if you go back to 2018, the only lines on that map at the time was this new field operated, which was essentially a test of drilling 8 horizontal wells in a single DSU up in this top left-hand corner. You fast forward to today, there's 30 odd wells now drilled within that blue box, and the results you can see on the table there, you know, absolutely stunning results. They're premium wells, they're big wells, they pay out quickly, and they throw off an enormous amount of cash. And you can see where we sit there in terms of the results so far. Our Jewell Well sitting there as a top 10 producer in the play. You know, our Rangers Well sitting next to down here, sitting next to the Sundance Kid Well, which is, I think, it's showing up on the chart as being the second best well in the play so far. I think it'll surpass the Park Place well as time goes on. And then finally our Flames Well here, which is just sitting, you know, a few miles north of the Corbett Well, which again is you know, up there in the top 10 in terms of performance. So stunning place to be doing business. And we're completely surrounded now by some of these. You can see the list of names in here. These are the who's who of the publicly traded E&P companies in the US. And of particular note is Continental Resources, which took the opportunity during 2020 to essentially mop up aggressively most of the PE funded operators that had acreage in this area. And effectively now we're in a situation where Continental, you know, are by far the dominant operator in this area and essentially have us completely surrounded.
And we are there. You know, before we said we're playing with the big boys, but now we're actually showing that we're playing, but we're holding our own with you know, some of the biggest, if not the biggest, in the US.
Yeah. So just a quick recap. Most of you guys are familiar with this, but you know, just you know, going back and looking at the results that we achieved from the Jewell Well. So that was our first big well. You know, peak rate of 1,800 BOE. You know, well exceeding our pre-drill estimates. Really nice surprise in terms of the natural gas yield on that well. You know, we were at times we were getting as much as 140 barrels of natural gas liquids per million cubic feet of gas. It settled down to about 100 barrels of NGLs per million cubic feet now. But you know, what a wonderful surprise that was. And in terms of, you know, what that means, you know, from a financial point of view, you know, each barrel of NGLs is trading at about 40 or 50% discount to WTI. So you're thinking about, you know, how many barrels of NGLs that you're creating every time you deliver that gas stream into the DCP processing plant. Sixth highest IP of any well in the SWISH AOI. You know, I won't go read through all this stuff, but you know, peak, very nice peak rate on the oil, a very nice IP 90, which, you know, shows us that, you know, the well is continuing with sustained production. And, you know, we're very, very close to that well achieving payout, and our shareholders can look forward to some news on that front, you know, shortly as we finish up all the accounting and run through all of that. But, you know, that well is very, very, very close to paying out.
And it's a mammoth result to drill a well of this magnitude and have it pay out in 6 months. I mean, you just can't undersell that. That is a huge result.
Yeah. Those results really is what set us up for our December quarter results. They were absolute company-making results, or company-making quarter, if you like. Again, this is recapping stuff that everybody's already seen before, but you know, revenue from sales 3.5 million, up 800% quarter on quarter. Positive operating cash flow of nearly 2.8 million. So, you know, this is all based on a 40% working interest in our first operated big well. Now, I want people to keep that in mind when we get to the next slide. So we had 40% of this well, and it delivered up those results at a time when oil prices were lower than they are today. So moving on to our next two big wells. You've seen the impact on the previous slide of what a 40% working interest did in the Jewell Well at $80 oil. You know, try now and imagine what the impact's going to be from the ranges and the flames, where we've got, you know, north of 80% working interest. They're arguably bigger wells, longer laterals, and so, you know, the opportunity there for you know, company making upside from the contributions from the production of those two wells will really set us apart in terms of big production from a relatively small number of wells. Production ramps up quickly, you know, for us in these circumstances. So, you know, compared to some of our peers, you know, one well, 80% working interest, well comes on at 2,000 BOE a day. You know, you can see, you know, our production goes from you know, the 540 BOE a day we reported in the last quarterly report. We get a fourfold increase with just one well coming online. Bring another one online, you can see how that sort of multiplier effect works. So, you know, these wells have the opportunity to transform us from being a, you know, 500, 600 barrel of oil a day producer to a 3,000 or 4,000 barrel a day producer, with cash flow coming off that being able to be reinvested in our future development program. And we're doing all of this at decade high prices. Just a quick recap on what this HBP program is all about. And, you know, this is really, I guess, what I was trying to explain in that previous slide about the stacked layers of the cake, and you can see those in each of those in each of those diagrams. But a single well, so in the case of the Jewell DSU, the Jewell Well, the ranges and the floods, a single well in each of those DSUs turns it from being leasehold to being held by production, and proves up the reserves in both the Sycamore and the Woodford. And so you can see there the options we have in terms of you know, either infill drilling, you know, to bring all of that forward. So the success out of these three wells provides material cash flow to be able to fund the development. But we've got options there. You know, do we go ahead and develop the entire 20-odd well inventory of low risk, high impact wells? Do we develop and sell, or do we do a mixture of both? You know, so these are options that we'll have in front of us, and, you know, that the decision process will bring the same discipline and the same vigor that we brought to everything we do to get us to this point, to that decision process going forward. But fundamentally, we'll be throwing off a lot of cash, and we'll have the ability to be able to continue to develop this acreage position, and then look at ways to monetize it that will be in the best interest of shareholders. So the next slide shows where we've come from, I guess, in terms of the operating momentum through 21 and into 2022. I guess the keys for us here, we're getting more efficient. You know, we're able to, you know, concertina the time from spud to first sales. We've done a better job with the range as well than we did with the Jewell, and now with this funding in place, we're going to be able to do even concertina that even further with the flame. So the opportunity to be able to get from spud to first production in the shortest possible time frame is obviously key, and to be doing that again, as I say, in a time period where oil prices are at all-time highs is significant. The other thing that's important for our shareholders to understand here is that, we are, as you can see, compared to our peers on that previous slide, we are a tiny operator in the context of Oklahoma and US listed E&P companies. Our ability to lock in rigs and lock in services is really, key to this. And so having that funding in place and then having the cash flow coming is going to be really important, because as oil prices continue to creep higher, competition for those services is going to increase. And so being able to get this funding package in place this week, and to be able to lock in the Kenai rig to drill the Flames well, people don't appreciate. We had to go ahead and buy steel casing for the well ahead of time in a market where steel casing was going up exponentially in terms of costs. We had to go ahead and lock in a completion crew for the range as well. This is stuff that we have to do behind the scenes to make sure that we don't get overlooked when these much larger companies come into the play, drilling 20 wells a year or 50 wells a year with much larger budgets. So we're shoulder to shoulder with these guys and competing beautifully with them. And so the next step is, get this cash flow, and then look at the options that we have in terms of the grey area here, which is the forward development program. So what's been going on in the play generally? So this is a quick snapshot of that sort of 130,000 acre blue square that we looked at on the earlier chart. You've got Continental Resources, by far and away the most active in terms of aggressively acquiring acreage during that period from sort of 2020 to today. Camino and Brookside probably side by side in terms of our activity and our acreage position, and then others obviously. So what we're seeing here is Continental being very aggressive in terms of, once they've seen the results from these wells, being very aggressive in locking up this acreage position. And something to keep in mind going forward, as oil prices continue to rise and these guys are looking to replace reserves or replace oil and gas that they've produced, they're looking for low risk bolt-on acquisitions that can replace reserves and grow their production. And so, we're going to find ourselves, I think, beautifully positioned to have a fantastic de-risked acreage position immediately adjacent to all of their other operations, and command a premium for our acreage position. So the next slide really talks about, that some of I guess the detail of that three pillar approach that we talked about. But this is what we do. This is basically how we make money for shareholders. Right now, we're in this kind of revalue monetize phase. We'll move into the reinvest phase in the second half of 2022. But we're always looking, we're looking towards a horizon on what we can do back at this part. And as Gracjan made the point, we've got the capability to do this again, and the team's in place, and we're always looking for what's next around the corner. So this is how we make money for shareholders, and this is really, what we talk about, these multiple off ramps for value creation. We've shown, we've shown the market before that we can sell acreage at 10 times multiples for what we've paid for it. We've shown the market that we can do acquisitions at the low point in the cycle. We've now shown the market that we can drill, develop, and produce. So we are a fully fledged E&P company with a very small team, and we're ambitious. So I guess just to recap, before we go to questions, oil at 10-year highs, Our development program's been accelerated. We brought the Flames development forward by a full 6 months. We're fully funded, and the strong cash flows that come from this HBP program are going to give us enormous options in terms of how we move forward with the development of the acreage position.